Note Investors Forum. It's our third Zoom event. We've got some really good information. I'm really excited about the panel that we have, really seasoned from around the country. These are folks that I've known for 5, 6, 7 years. I know them well. They're totally trustworthy. I'll take whatever they say to the bank. You should too, after due diligence. But it's just really, you're going to find this interesting. Now, part of the presentation I put together, I've been, as a lot of you folks have been, I've been on multiple webinars over the last few weeks, taking different opinions in, just seeing what's going on, what's not going on, putting them through my filter, if you will. I'm going to share that with you. If you agree, great. If you don't, that's okay too. But I think you're going to find it pretty interesting. And then, so that's from the 10,000 foot view with the other national folks, if you will. Then bringing it to the guests on the call to bring it down to the boots on the ground, if you will, and what they're experiencing, what they're seeing in their own locale around the country. So I think it's going to add some really good dynamics. I've talked to several of you on the phone before this. I see Ed's picture up there. How you doing, Ed?
Hi, David.
Good. And others, just to get their twist on things. Ed's been around, gosh, Ed, you're even older than I am. And maybe older than Allan, I don't know. But Ed and I go back a long time. He helped me and I helped him way back in the day. It was all good. So anyway, let's get started. Can everybody see the screen? Just wave in your picture box. Okay, perfect. So again, it's May 13th. The title of our discussion today is America is Open for Business. Now what? What do we do? So as I mentioned, we've got several guests. Imran Shabab, he's in Washington, D.C., from Phoenix and from somewhere else before that. And I'll let him talk to you about that. Richard Thornton, he's from the San Francisco area. Brian and Michelle Winberry, they're from Kansas City. And of course, Allan Woodruff, who's a fellow Arizona guy. So let's get started here. Typical disclaimer that I always show. We're going to talk about a lot of different things. Don't believe a word we're going to say. Check it out for yourself. Get your own perspective. See where you are in the game and what fits you. Check with your advisors, whatever that situation might be. But just check it out. I had this slide the last time, and I think it's still appropriate for now. A lot of people, they're naive. Nothing's ever going to happen. We're good to go. I'm not going to go down that rabbit trail. Allan, you're laughing. Some people are just not grounded in reality. I think back to 08 and 09. There were a lot of folks that had their head in the sand. They didn't know what happened. All of a sudden, somebody came along with a machete, and they were gone. It is what it is. So I look at it as realistic optimism. What is that? I have faith in my long-term success. You should too. I mean, we all are grounded that way. That's why we're in the business that we're in. But you also have to be brutally honest about where things are, knowing that anything can change. There's so many different factors that are impacting everything that we're doing. You got to be realistic about it too. So basically, my term is cautiously aggressive. I mentioned this before too. Harvey McKay, he's like 87, phenomenal motivational speaker. He has a book, You Haven't Hit Your Peak Yet. I thought, how does that apply to Dave Franke? And I thought this picture of Monument Valley was just perfect. I'm 70 years old, it doesn't matter. I've still got a long ways to go. And I would assume you guys feel the same way also. Right now, and I got this slide from Paul Burkett. He's a note guy predominantly in Seconds in New York City. He's a pretty big player. And he had a webinar a couple weeks ago. So his company is Automation Finance. And he has a pretty big fund. But I thought it spoke really well of where we are right now. Everything is perfect. The plumbing is great until it starts leaking. So we've gone beyond the point of where it's being perfect, and something stressed the system. So here we go. Collective Genius, Jason Medley. He had a PowerPoint discussion. He's had 3 or 4 of them over the last month. But what came out of that was this. this is what we're under now is a stress test to where we are, what our finances are. It doesn't matter what your balance sheet looks like. It really matters where your liquidity is to handle things. So the key is to set yourself up so that you can really take advantage of what's coming up. Because these black swan events, you could say, well, they just happen. Well, they do, but you got to be prepared. So we're all ready for this. We just have to move forward with it. And so as you look at that, look at your business now. Personally, I'm updating everything I've got. Website, I'm changing my model in terms of what I'm going to be going after, meaning specifically I'm going after assets. I can always find a buyer if I buy the assets correctly, if I buy them at the right number. So if you build your foundation, you redo what you have or had that worked before, redo it so that you can move forward as things really move forward quickly. Now, again, this was off of Paul's slides. If you look at the marketplace, the debt market's about 45 trillion. The U.S. equity market, which includes real estate and lending, is 45 trillion. But what happens when things change? Because we all are tied into the stock market. No matter what we say, it's all a relationship. So in this case, the plumbing stops. Now the plumbing stopped in the loan business for this group, the servicers. Mr. Cooper, large servicing outfit, dropped $1 billion in value in 30 days. $1 billion with a B. Now they're doing servicing. They've got to, if a loan goes south, they've got to take care of the forbearances. They got to cover the payments. But it just nailed them. Aquin, look at their value. They're still struggling. So it's just significant of what's going on. Now in our world, the notes that we're handling, the servicers aren't doing anything for us except probably not much, just collecting 25 bucks, 30 bucks, 45 bucks a month, depending upon the company. But again, it's a sign of the times. It's okay. We work with it. But the point of the equity markets is, by sign of hands, when lending stops, what happens to values? They go down, right? In 2006, 7, and 8, when lending was free for anybody, what happened to values? They went up. So right now we're in a situation where the lending criteria is really clamping down. The non-QM products are going away. There's only 1 or 2 of them out there right now. And the what is it? I think it's Chase. They changed their underwriting to maybe 20% down. It's all different, but that's going to impact values. So to be on the positive side, when that happens, what evolves? Seller carry. So in terms of optimism and things that are going on out there positively, seller carry has always been out there, but it's even more so now. When people didn't need money, they need seller carry. A lot of people didn't want to deal with it. But if you work the seller carry properly with the proper due diligence and set things up appropriately, it's going to keep those numbers up there. So it's an opportunity. Mark that down in your book. Seller financing is a big one. Now, what happens when those folks, when the sellers take back financing? Do you think they're ever going to want to get out of their paper? If you think about Qatar, when you think about Texas, West Texas with the oil and all the seller financing and the workers there, what about those lenders? Possibilities, right? Yeah. So, but if there's no debt, there's no sales. So you got to have debt somewhere in there. And also, as this changes, and we haven't seen it yet around the country, I mean, every market is still flying. For how long, I don't know. But prices should flatten. They just can't keep going where they are. But again, opportunity. Sellers want to get their numbers. They can't get it because the numbers don't make sense, but they might do with seller financing. So overall, if you talk to a lot of the folks out there, we're going to see prices flatten in the next 12 to 24 months. Anybody, and we can talk about that later with our panel. So again, on Jason Medley's call, John Burns is a housing consultant. He's high-end housing consultant. He had a little talk. And this is really, what's interesting is this whole event is causing some changes. Office space, values, vacant up. People are going to want to work from home. It's setting up a ton of opportunities. So if you look at this map here, Look at where people are moving from and moving to, according to Burns. I thought that was really interesting. Take it further, there's a breakdown. Home builders, they're going to be picking up some of the pent-up demand from the apartments. Home buyers, they want to move from the cities. They don't want to get stuck in this cluster, and they're going to be moving out. That's the general predictions out there, if you will. And the relocation of jobs. So if you can live virtually, or if you can work virtually, you can live where you want. It doesn't matter. So again, the opportunities. Now Ed is doing single-family rent to build. Great opportunity. People want to get away from the vertical and go to the horizontal. They don't want to be confined in those spaces. And commercial real estate, we know where that is. There's going to be a lot of malls being distribution centers down the road, one could possibly think when you think about what's going on there. So again, it's just opportunity. So how does that work when you're buying notes, when you're doing financing? Who's your potential buyers going to be? Where are they not going to be? If you go back to the previous slide, again, look at the map here. Where are they moving to? So obviously, this would be what, Atlanta, North Carolina, over to Texas area. Moving from California, it looks like this might be Denver. And this one really surprised me. From Northern California to Northern Michigan, really? To be locked down? And then from, I guess this would be Chicago up to the Northeast. That surprised me too. And also moving to Seattle. Still another surprise, but the move to Florida from St. Louis is not a surprise. So again, it's opportunity. And that's the whole frame of what I want to make out of this call today, is that we got so much opportunity in front of us right now. So if you look at the summary of what John had, people are going to want to live where they work, or work where they live, if you will. And the jobs are coming back, they're starting. But the business relocation is going to be huge. Working from home is just going to be the thing. Now, we were talking about raising money. I saw this in USA Today the other day. I don't know if many of you folks have seen this, but Oak Tree Capital, they're in a $15 billion raise for non-performing notes. What does that say, Allan? Opportunity. They see it, why not us? Right now, let's just say it's day one. Imran, what are you doing?
Oh, right now, today, this market, man, I'll be getting ready. I'm 10 years ago, 11 years ago, I was in bad shape, but I have taken the time to prepare all this time for this day, and the day has come. The day has come. I'm preparing. I'm getting ready. I am building my network, my sources, and I have been doing well. But I see big downfall for investors right now.
In what way?
Opportunities. I invest. I guess we're going to go over that, but I invest in.
Talk about what you do. Just tell the folks about what your specialty is.
Yeah, so I focused on non-performing loans. I buy non-performing loan and work them out. And last 6-7 years, I've been focusing on non-performing junior lane, or the second lane. And I have kind of mastered that area. I'm still learning, but I'm doing well right now. And when I started back in 2013, 14. We were able to buy a lot of loans at very good prices. The last trade I bought last year in 2019, I paid almost 4x for those notes that I paid in 2013, 14. And
say that again, Imran. Say that again.
So whatever I paid in 13, 14 is for the same type of product. I paid 3 to 4x last year. The price has gone up so much.
Wow.
And now, I still made money with those. Yeah? But now the thing is, with this crash, this economic downturn, the mortgage default coming, there will be a lot of people hurting, and a lot of people, a lot of banks have to sell those loans. So the opportunity is there that I'm going to be able to get my product at a better price than last year, and that will increase my profit margin.
What are you anticipating for what you're going to be paying?
That I still don't know, depending on how far we go down in this crisis. But I have been talking to some other lien holder. They buy like 10, 20, $30 million at a time.
Yep.
And now they need to raise some of the fund because they have investors to pay. So they need to sell. So I'm talking to one of those guys like that, and they want to sell about $1 million worth of note. So I'm working with them, and I am expecting a good price, but at least 30-40% discount than 2019.
Right. I remember back in the day, Imran, when Allan, you and I got started, we were paying what? You weren't in the first market really to speak of, were you?
I did for the first year.
Okay, so we were paying 25 and 30 cents for firsts.
Yeah.
And seconds were going for a dime.
Yep.
Allan, talk about yourself first. Do a little bragging.
All right. Well, I had a career in high tech, and when I got done with that, I was, by the way, a real estate investor since 1968, but it was more of a gentleman farmer real estate investing, just on the side, and I thought I was an investor. When I moved to Arizona in 2004, I became a full-time investor. I've been always buy and hold. I went through note school. That's where I met Dave, and I did just enough notes that I said, that isn't the game for me, that other people love it. But it really ties in with, each of us finding our passion and our place. I've always loved the buy and hold game. So I love all kinds of stuff people don't like. For example, working with tenants. I wanted to share a comment with Imran. I absolutely agree. We're in for a really tough time. I noticed the economist at ASU said he expects a V-shaped recovery. I thought that's absurd. Gary Schilling is the best economist I know. I don't know, it won't do any good to hold up his paperwork, but this is the latest insight. And he says, is this 1929 all over again? And he's showing the pattern of the stock market down and back up 50%. And people get all excited and say, oh, good, it's a bull market again. And in 29, well, that was just the presage for what was about to come. I don't know that he's calling this a depression or that we're heading to a depression, but certainly he's indicating this is going to be a longer recession than a lot of people think. A lot of people think, oh, good, we're off and running again, we're open up, and not seeing the immense damage to the business. So yeah, I do buy and hold. And like Imran said, I'm now pricing my offers at least in I invest both in Arizona and in Indiana. My pricing in Indiana, I've moved back to a higher return rate that I was getting in 2014. I'm not seeing the market there. I'm seeing too much optimism in the market, in my opinion. So people are still believing we're going to get this big recovery. And my job is just to wait it out. Whether that takes 6 months, a year, 2 years to wait out. I don't want to go in aggressively at this. If I get a deal that meets those better numbers, why I would still do it. So I've bought some tax liens recently, or not tax liens, but tax certificates, and we'll work those down. But I agree, trying to make sure everything is bulletproof. I run on very small debt to equity. I am raising some debt just to be in a stronger cash position and be able to capitalize on deals. And I'm also looking at selling one property that right now is a lease option, and it's up to my tenant to decide. But I'm encouraging them to get it done this year while the rates are great and so forth. So I'll be in a better cash position. So that's my basic outlook.
Okay, Michelle, I saw you just popped in. Michelle Winberry. I guess maybe she's on mute. Arlene, could you check and see if Michelle Winberry J6 is unmuted?
Yeah, she's on unmute, but I think her audio is not working.
Okay, okay. I'll tell you what I'm seeing from my perspective. I've looked at several tapes now in the last couple weeks. That's predominantly where I've been playing the space. And one of the folks I looked at, they were out of South Carolina. It was Vision, and they wanted 75 cents on the unpaid balance on performing notes. I said, no way. Then I went, and then the crash came. I went back to them and I said, I'll give you 65 or 60. And they laughed at me. They said, no way. So then of late, there was another company who pinged me, and they do a lot of seller financing. They're in Texas, and they had a tape of maybe 50 to 55 assets that they had created themselves, all seller carry, some of them seasoning 4 years back. And their goal initially was to do a hypothecation, which means that to use the loan, the existing paper to collateralize a loan, but they only wanted 5%. I said, I don't think that's going to work. He said, okay. I said, would you consider doing partials? He said, yes. So what they want to do is do a couple $1 million raise to take advantage of what's coming online. Now, what surprised me was being where they are in the oil country there, out of their 55 loans, only 2 were behind. That I found really surprising. And Cutter, I think, let me unmute you for a minute, Cutter. Can you unmute yourself, Cutter? Nope.
Yes.
Okay, there you go. Does that surprise you?
No, I mean, what I'm hearing is that the PPP loans are keeping a lot of those guys afloat. A bunch of those companies got millions of dollars, to keep their employees on. And when that money runs out, then I think that number will increase.
You know what surprised me too, to that point with the oil industry, is that I had a guy out of Texas and he's an oil guy. He runs like 28 platforms. He's a manager. 3 weeks ago, he had to lay off all his staff, 20 people, because the oil dropped out. And he's concerned for his own job. So all those folks were gone. So I thought that would have been a precursor to what was coming. But again, like you said, maybe the relief helped a lot.
Yeah, that's what I'm hearing, is that relief has shored some of these companies up, temporarily.
Right. Okay. Hey, Imran, we didn't get into your background. Give us that long story. And I apologize for that.
Sure.
Give me 1 second. Imran, I just want to say hello. I haven't seen you in a while. This is Cutter. Anyway, go ahead.
Cutter, I saw you. Good to see you. Actually, I see a bunch of other people that I have met while I was in Arizona. I see Rodney Newman. I know him. I think he had a fabric company or something. I remember meeting him in a restaurant. So yeah, that's great to see you all here. So I am. My background is I'm an electrical engineer. I worked for companies for 15 years in companies like Intel, Medtronic, Texas Instruments, Motorola, and then I started investing in notes with Allan and Dave. We started together back in 2012, I think, the end of 2012, 2013.
Yeah, 2012, early 13, yes.
Early 13, yeah. So, but before then, I had some rental portfolio, like small multifamily and some single family. Back in 2005, I bought my first house in 2008. In 2005, I sold it. I made a lot of money, and I thought, my God, I'm so genius. I know the game, so I bought a bunch of stuff, land in Scottsdale, houses in Gilbert, Chandler, Tucson. 2007, 8, 9, man, that crashed me. I lost everything. And it was really bad time back in 2009. But anyway, so I got back, I started, then I realized that, I needed to learn, I did not know the game. So I decided to, get into, training and education, and I started with Note School and met those guys there. And I remember me and Allan bought the first note. We bought together. He bought one in Wisconsin. I bought one in Wisconsin. Yeah.
Communist capital of America.
Yeah, and I still have that loan. That my loan worked out. I got the property deed in lieu, and that house has been renting since 2013, and that paid me several times over. And then I got more since I had a network there in a property management. I intentionally bought more first loan there to get the property. So and then management companies managing it. So, and I got other property through notes in Indiana, and then I have them as rental as well. But then I eventually, then I bought a bunch of other loan, where, those are very low value asset in the Midwest. And I got, not really crashed, but I lost some money onto those because, if it's a low value property, you really don't have much room. So room for error. And a lot of things can go wrong in this field. So then I, learned about second space, and where I can buy the second behind a performing first for a very low amount. And it's like an option play. You put a little bit of money, and if things work out, you cash out. If it doesn't, then you walk away, and you just lose that option.
Let me interrupt for a minute, Imran. To that point, seconds were going for a dime. You'd buy a tranche of 100,000, and whatever. Now, wait a minute. What do you see? This is looking forward, not looking back. Looking forward. A lot of people are still going to the piggy bank. Do you expect to see that again? Because you own that space.
Yeah. During this time, these banks are doing forbearance. And initially they said it's 3 months. Now they said 180 days, extendable by another 180 days. And a lot of them, after the forbearance end, they're not going to be able to collect those. So they're planning to put them as a second loan on the back of the loan. And, there will be a lot of people hurting, no matter how much money you put, if the economy is not, strong, there will be a lot of default. So we're expecting, what we hear from the industry, there will be a lot of opportunity, maybe not at the level of 2008 and 9. I mean, I hear two sides of the story. Somebody said it's going to be the worst one, like Great Depression, or maybe worse than that. Or some people say it's not going to be that much. It's going to be, it's going to recover after some pain. But regardless which way it goes, there is opportunity for us. I mean, it's going to go down for sure, for however long. So I am expecting, the prices to go down and play in a bigger scale. But I don't know if it will go down to 2008-9 level.
Okay, so you have a story which we're going to save to the very end.
Okay.
Imran killed it on one deal. I call it an anomaly. I think you do too, probably, don't you?
It is an anomaly. Okay. It doesn't happen every day.
It's going to be a story that you're going to want to hear, so stay tuned. Richard, I see you got your dream machine behind you that you wish you could go to. Is that a gym or is that an office?
It's an office, thanks.
Oh, I thought it was a gym.
Yeah.
Okay. So let's talk about Richard, who you are, what you do, and then also get into where you see yourself going in this business, short term, 30 days, and then your longer term picture for, let's say, a year out, and then fill the blanks in where that's all going to get you to your 5-year plan.
Okay.
So 30 seconds.
Yeah, I've got 30 seconds. Okay, great. Yeah, I've been in notes for 4 or 5 years now. I started a mortgage banking company in 1980. I'm dating myself. And we sold that. It was a commercial mortgage banking company. We lent nationwide. We had about a portfolio of about $8 billion. We sold it to a bank. And then I invested in senior housing for a number of years with investors. Larger projects, we'd go out and buy a $20 million project, and I'd raise $5 million, put a $15 million mortgage on it, that type of thing. And then the REITs came in and sort of obliterated that market with their big money, and the recession came along. And so then I started flipping and doing hard money and things like that. My focus right now is primarily just as yours, Dave, which is buying performing notes, and I'm enjoying that. I still have a very active partial business. I've actually been surprised by some of my partial buyers. They've been willing to continue to buy. And I've held off with a couple of them and said, hey, look, let's wait and see if we're going to continue to get payments here. Knock on wood, I'm still getting payments. We'll see what happens after September, but at this point, things are still looking good. So that business is progressing, but where I see myself really pivoting to is maybe lease options and maybe more structured deals. And I'm certainly focusing on tired landlords. So I'm starting as we speak to do mailers to FBO buyers, people who have bought through their self-directed IRA for the benefit of, that's what FBO stands for, and mailing to them and saying, gee, do you have a project that property that you want to get rid of? I can help you with your structure a note, and or I've got a way to help you defer taxes that is not a 1031, which will allow you to buy notes. So that's my immediate pivot, more into lease options and more into structured. I'm going to maintain my partial business for right now to the degree that I can, and hopefully I can buy stuff for a much better price.
Okay. Michelle, can you hear me now?
Yeah, can you hear me?
Yes, perfect. Thank you for making it. I appreciate that. Is Brian with you, or are you all by your lonesome?
He's not. It's been a crazy day. You know how Wednesdays are for us to begin
That's
with.
right, because you've got your own meetup every week or every other week, don't you?
Every Wednesday morning, yep.
You're from what, Kansas City, Mo, right?
Yes, on the Missouri side.
Michelle, maybe you could share a little bit about you and Brian. You've been. This is with love that I say this. I refer to you guys as animals. The way you do the business, you just kill it, just absolutely kill it. But also you've got a bigger heart, a bigger calling with your kids. So just kind of talk about you, Brian, your business, your love, other than Brian, and then where you are now and where you see things going in the next foreseeable future for the next 90 to 180, 200 days.
Okay, and I have 22.5 seconds, right?
Well, you've got 5. Go ahead.
Okay, sorry. Anyway, let's see, Brian and I were foster parents, so that's where people start talking about our history. We ran nonprofit association with regard to foster and adoptive families for a long time. And then we got into the real estate business. We'd always kind of had one foot in and one foot out. And so we started getting involved, and we did flipping and holding, and decided we wanted the cash flow and to be landlords. And somewhere along the line, we had done some seller finance kind of on our own, kicking things around and playing in the thing. And so when we were presented with an opportunity to get involved with note school and some of those things, we already had a pretty good background and understanding of what it was, so we jumped right in and did more. We do a lot of seller financing for a while when was it? Back in 10, 11, 12, 13, when things were quite interesting price-wise. We bought a lot of non-performing assets, did a lot of scavenger hunting and creating interesting things out of those. So we really enjoy it. I have a heavy research background, so skip tracing and finding things is my specialty. And so we do a lot of that. We do training of our group. So we have a group that we run in Kansas City of real estate investors and vendors and hard money lenders, and just a wide variety of real estate individuals that we do every Wednesday morning since 2010. So it's been quite the labor of love to do that for so long. And we just mastermind it. We kind of talk about what's going on. Sometimes I just throw out questions and kind of guide the discussion about where are we in our business, what do we need to be doing going forward. So
can I interrupt you for a minute, Michelle?
Sure.
Conversation, if you had your meeting this morning, what was the tenor of the conversation? What were the folks in your group saying, and what was your response in terms of taking them down the right rabbit trail, for lack of another term?
My group is really pretty positive all in all. Right now, I'm pressing them on creative strategies on how to make their business better. So I just kind of listened to what they were saying, and we're not having a lot of problems here because we've been data tracking the MLS in Kansas City now ever since the pandemic started and since the shutdown started. And so I've been tracking what's going on in real estate in general, because I think that there's a niche opening. We've all heard it, we all believe it because of being in the note business specifically, right, that there's going to be alternative financing necessary to get the world through this. But in Kansas City, we are on a less than 2 month inventory. Everything is selling in less than a week above list. We're still in a very, very aggressive market, but we also don't take the severe peaks and valleys that other areas do. And so we were just talking a little bit about that and what we think opportunities will be subject to seller financing, those sorts of things, and just kind of encouraging people to kind of keep their eyes open because the lenders are pulling back and keeping their powder dry, so to speak, changing the rules on the hard money side, which is, so what I'm seeing is a fleshing out of the system. We're fleshing out wholesalers that are new or too aggressive. We're fleshing out new people, and we're the people who actually engage, educate themselves, surround themselves with proper folks are going to be able to make it through really well.
Okay. So subject to, so let's talk about that for a minute. Okay. Is it early yet for that? Do you see that coming, or how? I mean, because with all the stimulus, fake money out there, when do you see that coming to play in a big way?
I don't think it's ever going to come in a big way, honestly.
Okay.
And the reason I don't think that is kind of a little bit, I pushed back on a couple of the guys this morning, is that some of them think, oh, that's coming and it's going to be big. Because they think people have overbought at these lower interest rates, and so that's going to make an opportunity. And it may, but I think it's going to be a short-lived opportunity because I think we're going to pay the piper for what we're doing right now in regards to stimulus and interest rates and things like that. And as inflation happens and as the interest rate creeps up, it's not going to be feasible, because once you get beyond where everybody's been sitting in the 3-4% range or below for the past few years, once you get beyond that and the interest rate increases beyond that, then it's no longer something that the bank is going to turn the other cheek on the due on sale clause, because they can reinvest that money higher,
right,
and start aggressively seeking the due on sale clause, which I've seen them do in the past. So I think it's a possible niche, but I don't think it's long lived. That's just me.
Are you doing lease options at all?
No, straight seller finance or nothing.
Why have you looked at lease options, or what are your thoughts on that?
I don't want to be on the deed. If I'm going to be on the deed, then I'm going to rent. If I'm going to try to play the lease option game, because generally when you see somebody do the lease option, it's because they're trying to be seller finances with control. And I just don't see it, especially in my area. We can foreclose relatively easily. I don't see it's necessary to play the game. Either they're financed and they're the owner, or they're not, is my opinion.
Okay. And I'll be getting everybody's contact information at the end of this call. But Michelle and Brian, Renee and I, Ray Girl and I had a property in Kansas City, and we thought we had a real showboat there. Just a real gentrified asset. Until we got into it, we found out it had a lot of structural issues. And then the entitlement was okay, even though it was weird. But the net was the tenants that were there moved out on our note payers, so they stopped paying. And then I was in Kansas City for a meeting, and I actually walked past the place. I thought, oh my God, we're in trouble here. So we went to Michelle and Brian, and they bailed us out. I'd even sold a partial on it, so we cashed out our partial buyer, and Michelle and Brian found us somebody to buy that asset. And Michelle, I sent you a picture of that last week, and you made a comment on that. So Renee and I, maybe if we were lucky, we made $3,000. If we were lucky, it wasn't a loss. But tell us what happened to the guy that bought it and what he did wrong, especially with the way the economy is? Because I think it's a great lesson.
He was, he's an absolute fabulous rehabber, does beautiful high-end finishes, and he went into the deal and thought he was going to put $125,000 in rehab into the property and sell it. And he ended up well over 200, maybe 250. His hard money lender almost ended up taking it back before he got it sold, and he sold it for, I think it was 307, and he barely broke even.
If you guys want to go to Zillow, it's at 401 Garfield in Kansas City. Absolutely stunning pictures on the rehab.
Oh, he did a fabulous, fabulous job with that property. So he definitely brought it back from the depths, but he almost didn't make it out of that one.
So Michelle, what are you seeing? Can you see my slide there that says COVID-19?
I do.
Okay. So if you look down that list, what do you see for pricing expectations with bottom fishers? And of course, we're all bottom fishers in our own way. And what kind of connects or disconnects do you see?
Gosh, and I'm in such an anomalous market than from some of you guys, because I'm kind of in this, they were describing it today that we're kind of in a tent in the middle of the country. We're kind of protected from everything. We're insulated.
Well, that point though, there's a couple people on this call that they have invested in Kansas City. So Kansas City is Midwest. So what you're going to talk about Kansas City could be Indiana, maybe Allan. I don't know. Just share some wisdom.
I was looking to see, and that was a question I posed to the group this morning, is are we adjusting our maximum allowable offers on things? And the group's consensus was absolutely not. We're still buying as if we were at the peak before this happened.
Really?
Because if you don't, you're not going to get the deal. We are so low on inventory and everything is selling so fast at above list. There's no room to be a bottom fisher, as you say. There just isn't. You won't get the deals. I was kind of surprised because I expected this many weeks in, as we've been tracking the numbers, that things would start to shift, and they're not. We actually shifted higher. We probably had another 20% more sales this last week than we've had every week, and we've been going up every week with the numbers of what's sold and pending and those sorts of things. And we had less this week than last week falling out of contract, because I thought that was going to be our next big deal, is that things were going to fall out of contract because of lending issues, and they're not.
To your point, all the iBuyers had left Phoenix. Guess who opened up the shop again yesterday? Open Door.
Open Door, yeah.
Oh, no, I'm sorry, OfferPad. They're back in it.
Yeah. I think they stepped out just to take a minute to kind of look at things and see how things were going to go, and they saw it's going to be fine. And that's kind of what I told them this morning about, the next couple of weeks of whether even to physically get back together. I think everybody's watching as we open back up and as things go and don't turn into some sharp, zombie apocalypse of, people dying and getting sick. I think everybody's going to put it behind them pretty quickly.
Yep. Allan, quick, you can see the questions on the screen, and we talked about a lot of this. Some of this you've touched, but you do a lot in the Indianapolis area, and you're doing the rental thing. I'm assuming, and you've also sold a lot on paper here in Phoenix. But maybe you can just run through the questions and see what would be.
Well, first to Michelle's point, I agree that the markets are hot. I mean, Phoenix market's still hot. I mean, in terms of rentals, in terms of sales, I don't see cracks there. If you look at the Cromford report for Phoenix, why they're saying, yeah, it's come down. The Cromford index has come down from some insane level 300 down to whatever, say 300 to 200. It's still very much of a seller's market. I've got a friend here in Prescott. I'm in Prescott, Arizona, 2 hours north of Phoenix. A friend of mine just sold a house. He got, in the first day, he got a full offer, $1,000 below asking price, full cash offer. The next day he got a backup offer. The next day he got a second backup offer. The market is hot. It's hot here. And by the way, it's also hot, and I was surprised at that. I've got a a broker who runs a large part of the business for me in Indiana, the market is just as hot there. So no cracks. So my concern is what happens, not just not in the next 30, 60, 90 days, but what happens at the end of December, what happens next March, what happens next June. My inclination is we're in for a longer slug. And what's that going to look like? I think the good news is real estate's going to be a better place than most. I mean, I think of the place where I go to yoga. How do they do business now? When you pack 30 people in a room and now you have to social distance and now you can pack 5 people in, how does that business model work? Same thing. And I went to Olive Garden last night and there were two couples in an area that before would have handled 5 times that. There's going to be a lot of businesses that are impacted. How does their business model work? And that's going to take time to shake out. What companies go bankrupt? What happens to those employees? The technology changes. There'll be a lot of technology change that'll influence, and that ties into commercial office space. So, I think like Michelle's saying, there's markets that look great, and I'm optimistic that Phoenix area. I'm optimistic is going to do fine price wise. I don't think it's going to crash, and I probably won't be seeing anything there that I want to buy. I'm willing, with my business model, I don't have to be buying, I don't have to be selling. I can sit, and my concern is, can I collect my rent? So far, so good. What happens after the funny money goes away? What happens when jobs adjust? That's my concern is number one is surviving through this with all the unknowns. So I hope that the optimistic people are right. I would love it if it ends up being a V-shaped recovery. I just don't buy into that. I think it'll be an L-shaped recovery. And I mean, people who are saying it's all over, we're back to normal in January of 2021. I don't think that's the way it's going to roll out. So for my business model, I've got to be, whether you call it pessimistic or realistic, whatever you call it, I need to be in that camp so that I don't lose. So.
Okay. And Richard, I think you can see the screen, can't you? You're
Yeah.
those points. And Imran, can you see the screen okay?
Yeah, I do.
Could you guys just kind of interact on the points that are there? I asked Richard to help me with some talking points. So he went out into the marketplace, people that we know of, and put this together. Richard's primarily in notes, all notes, and looking at some other rabbit trails along the way. And Imran, we know where you are in seconds. Could you guys just kind of pick up and just interact on this slide as it may or may not pertain to you?
Who do you want to go first?
Let's do Imran. He's going to talk for a bit.
Okay.
I see these points, and I don't know who came up with it, but this is right on. This is what experts in my industry are talking about, is keeping your powder dry, raising capital. That's what I've been doing. I've been contacting new banks, smaller banks, keeping relationship open with other hedge funds that I have relationship with, and I'm building relationship with other hedge funds now because of these opportunities that are coming. But is it going to be 30 days? Probably not, but it is coming. It might be 60, 90 days, 6 months, what Allan said. It is going to be, we're in it for a longer term. That, how deep, I don't know, but we'll be in it for some time. But I just think, what we're hearing that, maybe 3 months to 6 months, we're going to start to see some product in our space.
Right.
3 months to 6 months.
So with that, Imran, are you buying now, or are the prices still way too high?
Oh, no. So I was talking to this hedge fund. They bought, they said about, $3-4 million worth of loan a week ago. And they said they have been working on it for a while. And right before closing, they had to do another fade because the market has changed. So they actually adjusted price for the first time to buy at a lower price. And I'm gonna buy, and they have $1 million worth of note that they want to sell. I mean, purchase price, and they haven't given me a price on those yet. But they said it's going down. It is lower because they are buying it. They already started buying at low price.
Okay, let me stop you there for a minute. What does that mean? Define what a lower price is today in today's seconds market. How much percent of UPB or whatever? And I know it's deal specific, but
yeah. So these are some top quality notes. You know, with a lot of equity, first performing, the best note that you can buy in the second space. And he said what he paid for 67 cents in 2019.
Did you say 67 or 57?
67.
67.
Prices went up quite a bit. So he paid 67. Now he paid 45 on that.
There you go.
Okay. I have paid 45 cents on the dollar. I mean, and that I bought early 2009, and they bought just last month. So the prices are pretty high still, but it started to go down. But I'm thinking, the stuff that we paid 45 cents, we'll pay 30 cents, 35 cents on the dollar in 3 months to 6 months.
Okay. So you're just sitting back, but you're also getting ready to get ready, so to speak. You're ready if there's something there.
I am ready. I have a network of people. If the trade is bigger than I can take, we can combine together because, this guy said, it's going to be $1 million trade. So I need to bring in some other people, to take it together. And then, so I'm always networking, and I have a group of people that play in the note space, and I'm raising fund myself. The powder dry, that's the place I'm working on.
Okay. And what I'm doing in this perspective, I've went back to some of my smaller notes to the payers, and I could sell the notes at a discount. I bought them right at 30 cents. But I went to them, I said, I'll discount your note 10%, 15% if you want to pay it off early. I had 3 that raised their hand and said they're ready to go. So again, raising capital, because if I held it, I'm still going to have servicing fees and other expenses. This way I get my money now, my yield's way up, but I've got money sitting there ready to go. And Richard, you want to address, since you put this together, you were so gracious to put this together, you talked to a bunch of people, so you can speak for probably 5 others that you spoke to.
Well, so I guess the big thing is as I was sitting here listening to everybody else's comments, is we've got several cycles going at once, as always. Let's talk about the COVID cycle. We've got that. I think I would pretty much agree with what Allan was saying on that. It's probably going to be Q1, Q2 next year before the proverbial shit really starts to hit the fan there, and we start to see a lot of product be brought to and sold by the banks. My thought on marketing tired landlords is that you are going to have a lot of people who are feeling, you got a lot of boomers who got in, who want to get out. That was sort of already going on. It's accelerated by the fact that we've got the COVID pandemic going on, and they want to unload. And so we can now, hopefully, in this short window, buy at some very good prices. And I'm talking primarily about first and performing here. You could do the same thing with second sell. So we might have the perfect storm of actually being able to buy at a really good price and having a lot of clients who want to sell their property. And if we use an installment sale trust, so that they don't have to pay any taxes on those, and or even if they do, they're going to have a lot of cash, and so we can sell a lot of notes. And in a lot of instances, I think we can probably make $10,000-$15,000 a pop.
Yep.
On even just selling a whole note.
Right.
So I'm trying to marshal that, especially out here in California, where I'm looking at bigger ticket sales. I mean, a lot of the properties I'm going to be buying are going to be $800,000 to $2 million just for homes, just for a single family home.
A lot of exposure.
Yeah.
Yeah. Okay. Okay. And I guess part of what I'm doing is, if you look at the orange label at the bottom, I've updated my website, and that's where I'm going, which it says buymyloantoday.com. Bob Bollinger, you've been sitting there. I have not. Let me pull you in for a second here. Can you hear me, Bob?
Dave, I'm sorry. You said you're going to buymyloan.com. Tell us a little bit more about that. I mean,
if you put that into your browser,
right?
it points directly to Capstone Capital. I'm doing the whole website over, and basically to look for folks that are distressed, or feeling distress.
I'm distressed. Are you distressed?
Yeah.
Okay. All right. Just want to make sure.
Yeah.
All right.
Go ahead, Bob.
Hey guys, how you doing?
So Bob and I have known each other for a while. He, like Imran, he sold a parcel several years ago, and it decided to mature out, so to speak, or pay off, and he popped a pretty significant 5-figure number. But he's also had some other downsides and with DK. So let's talk about due diligence, Bob, and what you're doing, and why, what has happened, and what you wouldn't do again, and how that could help people now.
Well, I've had some unexpected downturns and payers and everything. I guess one of the things that I would not do again is to be as lenient. I need to be more totally businesslike and not accept every reason why someone would be late on their payments. I'm not going to go into the whole details there, but I just, I like Richard. I think that there's a great opportunity for lease options. It's coming about. I've been probably since 2000 a full-time investor, and I've seen the cycle. I don't fully agree with what Michelle was saying about the sub-twos. There are ways I think you can work around that if it's structured properly. I saw a great plethora of sub-2 deals that I did back in the early 2000s that worked out really quite well for me. I subsequently sold off just about everything I had when I got into notes back, I guess, around 2008 or 12 or so. I forget. About 2012, I got rid of those. I've seen the cycle. I'm thinking that we are in a cycle that kind of parallels what I was seeing in like 2002, 2003. I'm thinking that we will find a tremendous opportunity in there. Like Allan said, like Michelle said, I'm seeing the same thing here. The market that we've got here in Virginia Beach, the Southeast Virginia area, is really quite hot right now. The fewer properties available for sale, people are chasing them. Prices are selling at 100%. Although I'm kind of, and I think Dave, I mentioned this to you, I feel that the some of the flippers who are paying top dollar, and they're like Allan said, if you don't pay top dollar, you don't get the deal. But I've got the feeling the chicken has already been decapitated. It's running around. It doesn't realize it's decapitated. And I have the feeling that as the impact of the banks and their tightening of their lending requirements hasn't hit yet. People don't realize it. They're still running around paying top dollar. It will hit them sooner, or well, it will hit them sooner or later, probably a little bit later. And I'm thinking towards the latter part of this year, going into early next year, that we're going to see a even more significant downturn in the market. I think that we will come up. I don't think it's going to be a V. I think it's going to kind of be like a U and then kind of an incline rather than a straight line up. But I just think there's tremendous opportunity. I think that the lease option situation could be a real opportunity. the opportunity with seller financing, I think is a real thing. We've all been in note school. We've heard what they've had to say about that. I just think that just offers tremendous opportunity, and it's just a matter of having the funds available, dry powder as you called it, and having other investors ready to go. And I think that this is a time not to pull back, but to move forward, actually. I'm personally not the best marketer. I need to improve that. I know that. Now is the time to go after the opportunities. And I think that I need to ramp up. I know I need to ramp up more marketing for the buyers. And I think that that's where the deals are going to be. I think finding the sellers, we'll find the sellers. We'll have tired landlords. We'll have people. And Allan, I have a question for you. You made a comment that you've got a lot of you're not buying or selling. You're living off the from the proceeds from your renters. Are you going to include? And this is just a thought. And I know we can't discriminate, but the people who are likely to not pay are those who aren't getting a paycheck. They would be more service industry. However, people who are more in more skilled positions, some kind of computer operator, somebody that could work remotely, would you alter the criteria that you have for your, or is that even legal? Alter the criteria for your landlord or for your tenants?
Yeah, well, absolutely. Well, first off, I've got a criteria scoring sheet that I use, and I actually send that out with a pre-app form to every prospect. So I show exactly what I do so that I am within standards of fair housing. So absolutely,
Excellent.
You can adjust for the quality of your tenant. And frankly, it's funny, I was just speaking with my wife that, maybe I shot myself in the foot because I've gone a little bit, I don't know if subprime is the right word, but it probably is close enough. I've gone a little bit subprime with the logic that these folks are going to stay with me a long time. I do have tenants who've been with me since 2009. I've had tenants in the past who had been with me as long as 14 years. And I kind of prefer that. Even though, when one rolls over, well, a lot of times I am a little below market, so I benefit when that happens too. But I'm still working through that. Right now, I think I've got some exposure there with the tenant quality, and that's one of the trade-offs. And I'd say that's one thing that caught me with this particular scenario, where I wish I were a little bit better positioned, but it is a diversified portfolio. I've got tenants that are just so strong, and others that I'm concerned about how will this roll. So yeah, I can adjust that. It's I don't know who knows Dan Valentine, but he used to say, he was my broker in Phoenix, and he used to say, Allan, you don't know who's going to go south. You just know somebody's going south.
Right.
So you make your best guess. But it is the reason that I believe I need to be in a strong cash position. I need to project that I will have some rent issues as we go through the end of the year and I believe into next year. And so I need to be ready for that it's going to be tough. And by the way, when the government violates the Constitution and takes away property rights as they've done, why, you've got an exposure there. By the Constitution, they can't take my rights. They can't keep me from foreclosing without fair compensation, but they did it. And attorneys, it's not me speaking there, it's attorneys who say that's unconstitutional. I don't think anybody's going to go back and fight the CARES Act, but let's face it, most likely it's unconstitutional. What else? I think that's a risk we all need to be aware of. What is going to happen with government action, not just this year, but going forward as a mega trend? I think we face a risk there. Definitely higher taxes is a real risk. We need to have our business models able to handle some of that sort of trend, global trends also. There's a great book, by the way. Do I have it right here written down? It's called DIS, United Nations. It talks about global changes. That's a great book to give. Too much, I think, in real estate, we look at it and we just say, well, it's regional, so I only need to look here. I don't need to worry about the cost of tea in China. That the price of tea in China can turn around and bite us. We're in a different world. So,
Okay.
yeah,
Good.
Bob, thanks. By the way, Bob, where are you located?
Virginia Beach.
Virginia Beach?
I'm a mile from the Atlantic and about 10 miles north of North Carolina.
All right. Thank you.
So Dave, if you think about it, we can almost time our investments and our investment strategy, because we can look at the markets around us. I don't know to what degree any of buddy in your meetup here wants to go out of state or out of city, but I'll give you an example of what I mean. Okay, if you want to go for someplace that's going to be really hard hit, but it's going to be a quicker bounce, you're going to go to Las Vegas. One of the reasons you're going to go to Las Vegas is you've got a whole bunch of hourly workers, a whole bunch of people have been laid off. The whole tourism industry is going to take a huge hit, and you're not going to have a lot of buyers, but I think it's going to rebound quicker than someplace like any city that's in the oil patch. You look at Lubbock, Texas, look at, all around Texas there. That's going to be a long, slow climb out. And so you could be in and out of Las Vegas and say, thanks, ma'am, and then move over to Texas and still have time to do investments there. And that's just on a macro basis. I'm sure you could do that within your state. You could find little areas like that if you wanted to.
Right. Okay. And I'm gonna pull up one more part. Michelle, are you with us?
Yep.
Okay. Can you add anything to the conversations? Because you are a great person to sit back and listen, and you always come out with so much wisdom. How would you fill in the blanks with everything that we've talked about so far?
Wow.
That's a wide question. I understand that.
That is a wide question. Do I get to answer with the standard, it depends?
Yeah. Okay.
Yeah.
Gosh, I don't know. The thing is, I kind of agree a little bit with everybody. I think there's opportunities everywhere. I think we are, those of us who understand real estate and understand the note business are sitting kind of in the catbird seat, really, as everything goes, because we've got the opportunity to be everywhere. So I would just say, be open, come around other people, learn what they're doing, and make sure that you do the best you can with all the knowledge that you have.
Yeah.
We're actually rolling out a bunch of seller finance because we're watching niches disappear in the lending. So we're seeing where the traditional lending is falling off, seeing what that number is, and we're rolling out and really concentrating hard on obtaining those assets at a right price and getting some seller financing out there to fix the affordable housing problems.
Got it. Okay. Imran, you've been listening in and you contributed a fair amount. I'm going to come back to you in about 5 minutes on the other topic, but generically fill in the blanks in what you've heard. And then I'm going to bring in another party, Colin, who wasn't expecting it. And we'll get into that, but just round it up for us.
I just want to say, if anybody is sitting on the sideline trying to, time the market, market timing is not that easy. But if you're looking to do it, I think this is a great opportunity to get busy, get involved. There are opportunities. Just jump in.
Okay. Now, Colin Mitchell, I think we met off the Capstone site, right, Colin?
Yes, I believe so. I just gave you a call one day.
Yep. And you're in the New York area, right?
Yes, Albany, New York is my main market, yeah.
Okay. So there was a party that pinged me on Capstone about selling a non-performing note up in Oneida County. And long story short, it was a horribly written note. The guy mismanaged it. It's been non-performing for 6-8 months. I did some research on it. Just the attorney fee, $6,000.
Yep.
Times 18 months to 2 years. At the same time, I checked with that same attorney. This is something to keep in mind for the future. He just finished up a foreclosure in New York City that he started in 2008, Imran.
Oh, God.
Wow,
So
12 years.
the story behind that was people started with a corporation, kept passing it on through 10 corporations and 10 bankruptcies. He just finished it up. So I brought Colin this opportunity, and he had an investor. And Colin and I both came to the same conclusion about the value. What did your investor say, Colin?
I mean, he said at the end of the day, there's just not enough meat on the bones, especially for that 2-year time horizon where you have a little more, he needs a little more risk premium in there. So it just wasn't enough meat on the bones to justify, that 2-year window.
Right. So the asset was a New England Cape on 5 acres in several outbuildings, all rehabbed in, I guess, 2014-15.
Yeah.
Value maybe $120. You with the lates at 90. And well, we were going to pop some money. Well, each going to pop $3 or $4 or $5 grand off of it. So I offered the guy 15. He said no. I said, dude, we're going to be there for 2 years. There's nothing there. So I guess my point is that due diligence is really important. And if nothing else, I think you learned that also, didn't you?
Yeah, due diligence is really important. But it's interesting that you said that guy said no. I mean, right now, what I'm working on recently is a guy that repositions condos and different things in Boston. He has a performing loan. The tenant that he is in there is a great job. Great credit, but he just is not really coming off his asking price. So it's funny that you say that this guy who is kind of motivated also didn't come up his asking price. So I just maybe want to pose this to the group. Is that something that you guys are seeing? Maybe we have to wait a little more in this cycle to see some deals get done, actually.
The answer is yes.
Yeah.
Yeah. So, okay. So let's move on. If you want to take I'll send out all these slides to everybody. But here is the contact information, and if again, you can screenshot it or you're going to get all the whole presentation anyway. But I want to. So is everybody good on that? So I want to move to the next one. This Imran, I just took the biggest one just because it's the anomaly and it's got more pizzazz to it. So Imran, like he said, he's been doing this stuff since 2013, 2012. So he found a cherry.
I found a cherry?
You found a cherry. I mean, you did okay. So do you just want to give a quick overview and tell me when to click through or what?
Sure. All right. First, the disclaimer. Okay. Not all deals are like that. Okay. It's like baseball. You make a lot of one singles and then you make a big hit, right? So this is one of the biggest one that I have received. So, and they put that up. First thing. But anyway, so this is a property in Seattle. And I'm sorry?
Seattle, Florida.
No, this one is yeah, to throw you off. It's like I have it everywhere. Yeah, it's in Washington.
Okay, all right. Go ahead.
Because I copied another one with Florida deal. So I had one Florida, one Washington.
Yeah, okay. All right. So at that time, when I bought this note back in 2015, in October of 2015, at that time, the fair market value was 820, right under 1 million. And if you see the numbers, the senior lien was 558, and the loan I bought, the second UPB was $156,000. So there's plenty of equity in this. This is one of the best quality note. Okay, I paid 14 cents on the dollar. So I paid 21.4K. Okay, so this loan was originated back in the heydays, and he defaulted within a year. The next due date was in 2006, so he stopped paying. So second payoff at that time when I purchased it was 188K.
But back in 2015, and this will change as I work through it because it took me, I believe, 3 years to work through. So let's go to the next page. So this loan changed hands. Okay, so from the originator to me, I'm the fourth one. So I buy from other hedge funds, right? So and people sell for different reasons. They run out of their time and they have to sell it, cash out. And I got this, and this is my own fund. My other investors are really more passive investors, so we can hold on to it as long as we want and make big return. I don't have to, close my fund anytime, in 3-4 years. So anyway, so the history is this borrower did file a bankruptcy in 2006 when he stopped paying. And then I was doing research on his, loan. He did loan modification twice. So he's telling me a story that he is gonna keep his house. He is not gonna walk away from this house. So he wants to work. He will work. Since he worked with the first lender twice, I'm thinking he will work with me. I'm the second lender. So I was trying to do modification with him to see what we can work with. But instead, he started taking legal action. And he sent this, QWR, that's a qualified return request to my servicing company, and asking for all kinds of proof. You have the note, you have the mortgage, show your tax return, whatnot, all kinds of stuff through a legal attorney. Anyway, so I got, and I'm connected to the people in the industry. And then, I was told by one guy, out of California, he was doing the foreclosure for me. He's like, Imran, go get a license. Washington has changed the rule. And as a second lien investor, you need to be licensed and bonded. And I was like, I have no idea how to get that. But anyway, he walked me through it and I got it. And then his borrower, his attorney contacted me a few times. I've been talking to him for a long time and blah, 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 all kinds of stuff. They want to, they wanted me to get away. I mean, just disappear. They want me to go away from this deal. And I'm like, I'm not going away. I'm staying here. So we went through this process. The other thing the attorney said, this borrower has few judges in his family, and they're well connected in the law firm, in the court system. So it's like, if you go through this, you're going to be in trouble. I'm like, I didn't do anything wrong here. I'm just a lender. I'm trying to fix this problem. But anyway, so they gave me a challenge, and I went with it. We did set up the foreclosure date on the 2016, and he filed a bankruptcy. And I did not know you could file a bankruptcy without a plan, and it just stops my foreclosure sale. It's really weird. You just have to file it, no plan, stops your sale. And then, he keeps delaying the hearing date. We went to December, and then we hired a BK attorney who is a top BK attorney. And I said, since they have a lot of judges, I'm going to get the best one, whatever cost that is. So I got the most expensive, the best one that I was referred to. And then in 2017, judge rejected their bankruptcy, or the trustee rejected their bankruptcy because there was no plan. And then he filed another one in new bankruptcy after the rejection. But then we went through this fight, and it got dismissed. So we're in the game again. So next slide, please. So the borrower hired new attorney. I mean, he's out of bankruptcy. Now he hired new attorney. And he's threatening us with lawsuits, for whatever reason, I can't remember. And they said, okay, you have to show that we have the original. I said, we have the original, and they want me to send it to them. I was like, no, Jose, I'm not sending you my original. My document repository was in a company in Missouri, and I said, you can go there, and they have a lot of restriction, and they're giving me, the attorney started to be annoyed and started saying, slangs at me, blah, blah, whatnot. He's trying to scare me. Anyway, so they said, they're going to pay $3,500, and the monthly payment was $1,490. And in return for canceling the sale, because, there's tons of equity. At this time, the property is worth more than $1 million. The market was up back in 2017, 16, 17. This is $1 million property. So what we did not take 3,500. We did take somewhere around 40. I wanted 50,000 down to stop the sale. Because of the amount of hassle they gave me, the amount of headache they gave me, I'm less inclined to work with them. So I say I need 50. Anyway, I think we settled for 44,000 later on, because my cost was 33,000 for my attorney. At this time, my payoff amount was $405,000. So all the 156,000 and all the accrued interest, late fee, and attorney cost, everything is 405K. So let's go to the next page, see what happens. So here are the numbers. Yeah, it's a little bit off. It's payoff amount is for my loan is 405K. Okay, so they paid me 40,000 back in September 2017 to stop the sale, and then he started paying me monthly $1,490 a month, and he did that till February of 2019. So I got pretty good monthly income from there. He sold it for $1.35 million. So at that time on the sale from the title company, we received 329K. 329, and then in the meantime I collected about $1,500 a month. So, and my total cost, including my note price and legal, was 54K. So my profit on this loan, my net profit is 335,000. And it's 3 years. So I do annualize, it's like 200+% every year.
How well did you sleep? How well did you sleep for those 3 years?
Well, I mean, I was worried, I was stressed because, I have not been challenged like that before. And the fact that he keeps hiring new attorneys all the time, and the attorney, when they say bad things, I'm kind of taking it personally. Now I don't take it so personally anymore, but there are a few nights, I was stressed. It's like, what the hell is going on, But once I got my attorney, the BK attorney, I mean, the way he was getting onto them, oh my, he was very, very good. He was detailed, and then at the end, they crumbled. And
that's great. What did the BK attorney cost you?
That was my total cost. That 33,000. So I started with one attorney, and then hired this BK attorney. He's also a litigation attorney, and then he did settlement.
Wow.
But the key here, Imran, for you started as a rookie, you're coming out as a really seasoned veteran, but you employed this phrase here on the lesson: don't give up, don't be intimidated, learn, build, and believe. So you're ready to kill it for this go around now.
Yeah, I got a lot of scratches everywhere. But I was so excited, I'm like, when I see the bank account, I'm like, man, this is sweet. I did not have this much bank balance.
Got 10 of these in your pipeline now too, right?
Yeah. And then ever since, I have been getting paid here and there, but my returns are pretty good. Not like this, everyone. But, I do well enough that, I moved to a suburb in Washington, D.C. I live in very nice place, knock on wood, but I have done okay in this industry, in this business, and I continue to do so. And I love it so much that I'm just 100% focused on this.
Perfect.
Great.
Okay.
Congratulations.
So, guys, everybody that's on the call, does this resonate?
Yeah.
Okay.
Absolutely.
Okay. Imran?
Oh, of course.
Okay.
Well, I see, in my space, I can afford, like, if I did want to walk away with $21,000 investment, I could if I wanted to. It would not hurt me. But sometimes, you don't know which, in my business, you don't know which one is going to be good or bad, because there are other examples that I had there, but there was no equity. If he went through foreclosure, if the deal went through foreclosure, I would lose all my money. But I made good return even though there was no equity in it. It's, so I don't know. For me, I'm taking a chance, and if I get paid on 40% of my investment, I do very well, and I will lose I will lose 10, 20%, but even with that, I make well.
Okay. All right. Perfect. Thank you. Thank you.
Thank you.
So really, just think about this. This is where we were and where we're going. I don't know. I just see it totally opening up. I just thought that was very appropriate. And then, of course, this fits a lot of folks that maybe didn't plan a lot. And that's where we are. So I want to run something past you. I have a question here. Bear, can you unmute yourself? I'm going to pick on you. Can you hear me, Bear?
Yep.
Okay. So why don't you share, we'll end on with you. Share your comment and go, you want me to read it or you want to read it?
You can read it. That's fine.
Okay. So Bear said, how much yield are you willing to defer while waiting on the sidelines if it takes time for notes or properties to drop into a nice price point? Question number one. And if you wait 2 years, for example, deferring 15%, or pick up something quicker with a little bit higher rate of return that pays off in 2 years.
Yeah, no, yeah, basically the kind of math I'm doing there is if for example, you let your powder stay dry for 2 years so that you can pick something up for, 25% less than what you can get it for today. But you're accustomed to making, 15% or so every year. So you're going to lose 30% waiting 2 years to pick up something for a 25% discount. I know it's a hypothetical.
No, I get that. So my answer to that is if the deal looks reasonable, grab it and flip it if nothing else. Just keep the cash rolling.
Say that again.
Richard, your thoughts on that?
Yeah.
Okay.
Yeah, I know. I mean, I'm exactly as you know, because of something you and I are doing together. I've probably got, if things go well, some notes that I could probably make 30% on, but I can do a very quick flip of those notes and do very well and move on. And so that's what I'm going to do, because I think there'll be something else down the road.
Right, exactly. So, all right, well, that's all I've got. I appreciate everybody participating and sharing. We have been recording. We'll forward a link to the recording. We'll put this up on YouTube. I'd like to do this again in a couple, 3 weeks. I'd be open for questions, comments, suggestions in terms of what you would like to hear, a guest you might want to see in the call, whatever the case might be.
Yeah, Dave, this is Jack Anderson. I'd be interested in hearing some comments from Stan Harley.
You want to flavor this? We can do that, but he might be kind of embarrassed now because in January he told us we could just go like crazy and nothing's going to happen.
Yeah, I'd be interested to know if we're in that downturn that he was predicting for 2022.
Okay. Anybody else?
No, Dave, thank you for putting this up together in this event. I think you're doing a very good service because I see people from different parts of the country are here, and we can talk to each other and share our information and our idea. This is very good. Hopefully it will help some other people to, make some decision.
Right. And now, Imran, if somebody had a question on the second, and again, they're not picking your brain just to pick your brain, would you be open to a short conversation, but not to abuse you?
Yeah. Maybe another day. Yeah, we can do some overview of the business I do.
Okay.
How I do it, the thought process. Yeah.
Okay. Allan, thank you. Have any other closing comments?
I'm good. This was fantastic. Thank you.
Hey, Dave, this is Richard. So if anybody would be interesting, something else I did come across, I mentioned that I have a way for people to get sell a property and to not do a 1031 and to be able to buy notes. It's a type of installment sale that you use through a trust. I'd be willing to do just a 10-minute overview on that if you want, so people could use that in their practices.
Bring your information. Let me bring everybody's information up here. Again, so if somebody wants to contact Richard or Imran, Allan, or Brian and Michelle, you've got my contact information. And I'd like to thank everybody for coming, and hopefully you got something out of this. And we'll be talking soon.